Yes, there's going to be a quarter of pain. I think the good news is that at least we're mentally prepared for it. But I think the word bleak is the word I've kept using to clients over the last couple of weeks, because clearly we've got a confluence of factors coming through here. The big talk is going to be about the trading revenues down. Yes, you're going to see trading revenues down in both equities and fixed income by between 20–30%, perhaps a little bit more year on year compared to the first quarter of last year. Investment banking fees will be also very badly hit because equity capital markets have been very sluggish. Debt capital markets and even M&A, while M&A is still quite buoyant in some respects, for one reason or another, the completions in the quarter, which matter, have been down. So that's one aspect. But in addition to that, we've also got the fact that the net interest margins of the banks, their lending businesses, are not going to go up particularly after the first rise we saw back in December. But then the big thing that people are going to focus on, of course, is energy provisions. How much are they having to take against the energy companies they lend to?
Just delving into the trading side first, what has been cited has been the lack of volatility, but if you look at how stock markets have performed from the start of the year, particularly the Dow from highs to lows, there's been some movement, and even in currencies you've seen dollar strengthen and dollar weakness. Why are banks not capturing some of this pattern on markets from equities to Forex? Is it down to the structural changes, the lack of prop desk trading?
Well, I think the first thing is if we look back to the volatility in August, September, we saw very good equity revenues coming out of that, if you remember. But that's because basically equity investors were moving their portfolios around out of emerging markets into developed markets. That's quite good business for the banks. What Goldman Sachs was saying to me when they were in London recently was the problem with January, for example, high levels of volatility, but basically investors just went risk off. So all they did was just de-risk. And that meant all they did was do lots and lots of electronic trades for tiny, tiny margins. And so Goldman was saying, we're not putting our capital to work on that. So there's no gain for us because clearly we get paid margin on putting our capital to work. So I think that's a big factor around the equity space. Now what we saw as a house was a busy February, but March just died a death because we saw the markets come back, and now investors are saying, well, we're not quite sure what to do next. I think on the fixed income side, it is more to do with volatility, or actually lower levels of volatility, the long volatility if you want. But again, it's also the fact that investors have been very cautious. So the high yield market, which is always a very good market for the banks, has been one which has been very, very sluggish again. So, net, it's just been a confluence of factors which are making this pretty ugly.
Do you think the banks have made that worse? So we were having a talk earlier about Tesco, which obviously totally different business, but they're doing a whole bunch of things that seem very short term, very reactive to me. Do you think that a lot of the way the banks are structured now is a reaction to the last crisis that went on, and therefore, the product mix, the business mix is slightly out of kilter as a result of that?
Well, I totally disagree with you. They're doing anything short term. I think they're doing things for the long term. The problem is, of course, particularly in Europe, but also in the United States, is they didn't adapt to what the new paradigm is, quickly enough, or in total. So what we've had is death by 1,000 cuts. So I think there's constant, looking at the cost base, getting the platforms much more efficient. Goldman's again talk about having their software engineers on the trading desks, working with the traders so they can reduce the sort of very costly traders and have a much more efficient desk. All this kind of stuff I think is very positive longer term. Look at the digital activity. We'll hear Jamie Dimon talking about Chase Pay today, digital banking, a lot of advances. But the problem is, as we saw with Nomura closing yesterday, everybody thought we're across the line. Have we done enough? Yeah, I think we're just about there. Then the next down leg seems to be coming. And talking to a client last night, their worry is, well, if energy provisions pop up so much in this quarter, what about the rest of the loan book? Because that's the next shoe to fall, isn't it? And you're sitting there saying, oh my goodness, that's absolutely right.